Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network Team members in person, you can contact us at info@expertnetworkteam.com. That's info at expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. So welcome to today's podcast. Today we have an interesting topic to address, and it really is unusual that we're even talking about this in the current environment, but we're going to be talking about strategies, both investment strategies and tax strategies for the newly minted ultra-high net worth. Again, like I say, Karl, it's kind of odd that we're talking about people who are reaching new heights of wealth during what has been just a dramatically troubling year. But what are you seeing out there? I mean, where is this coming from? And tell me a little bit about how we're finding these folks.
Nate, there's a huge divide in America right now because there are some companies that are just making a lot of money. We know their names, these technology firms, and a lot of their employees are suddenly very wealthy because they were given stock options or restricted stock or in other ways got equity in their firms before 2020 hit, and everybody moved home and their stock went through the roof. So this is an opportunity for some of those people to get to do something with their equity and to learn how that is. And we've met more and more of them this year than we have in probably 20 years at our firm since the dot-com crash. There are a lot of people who are very, very interested in how they can unwind a concentrated equity position. So we've got a lot of ideas about that, and we're going to have a great conversation today.
Yeah, so as I see it, there's two major problems here. There's both with these concentrated positions, like you mentioned, they're grants that are ordinary income. So
right.
The restricted stock units or something like that results in ordinary income, which is highly tax inefficient. So whereas one may see themselves as having, just for rough numbers, $1 million after tax, they have less than half that in
right.
some cases.
Right.
Which
Bummer.
Yeah, which is a real downer. So there's things that obviously need to be done there. And that obviously, whatever that tax load is, obviously impacts how much reinvestable assets you have. And so let's start with that. Let's start with strategies or how you approach deconcentrating someone, if that's even a phrase.
No, I love it. That's a great idea. Or just unwinding a concentrated stock position. And, there's three things that I measure in what we do on our website and in the white paper that I wrote and in the videos that we've broadcast, trying to share this information with as many people as we can, was you measured on these three axes, if you will. So on the vertical axis, I plot the complexity of a strategy. And so the higher up on the vertical axis you are, the more complex a strategy is. And then the horizontal axis, what I do is I just say the cost. And the biggest cost with all of them is always taxes, almost always taxes. And so the further you are on the spectrum of taxes, the more expensive it is. And then I plot a third axis by the size of the bubble, and I just say relative to the others, this strategy is more safe than some of the others. And so when you're looking at a concentrated equity position, almost always the best idea for people is to diversify, to get out of this big company. But it's sometimes very hard. And so sometimes the first decision people have to make is, do I trust that I'm going to get a better return somewhere else? Or do I even trust my employer? Do I trust this stock to keep delivering what it's delivered recently? Because I started...
Because sometimes it's hysteria that's driving it up, right? Or even market conditions that aren't necessarily sustainable.
There are so many. Yeah, absolutely. If you're at a smaller company, you've got a much bigger chance for growth than you do at a big company. So if your company's already experienced that growth, the growth ahead of you is not going to be the same rate as the growth behind you. So there's a lot of opportunities for these people, and there's a lot of decisions they have to make first and foremost. And so one of the first rules I tell people to do is just write this down and say, the first thing you got to do is get safe and then get rich. So with your concentrated stock, it's made you wealthy go ahead and take what you need off the table to stay safe.
Well, I'm going to stop you there and explain to me how do people interpret take what you need being the operative word?
Right. So at the core, it's all about your personal financial plan. So it depends on your stage of life and who you are, and every plan requires a planner. So when you start out here, the number one determinant of your long-term real-life wealth is your own behavior. It's your own decisions. And one of the best ways to make sure that you're doing financially consistent behavior is to talk to an expert, to talk to somebody who help keep you on your plan and keep you on track. And then from there, to make an investment set of decisions that are right in alignment with your values and your goals and your relationships. And then after that, to asset allocate, to decide, okay, I'm going to have this much in equities and this much in bonds or real estate or other investments. And then of my equities, how much do I want to keep in this concentrated equity that's made me so wealthy until here? And if I'm safe at that point and that my financial plan is going to work, I'm going to, have enough forecasted in retirement. I'm going to have my mortgages paid off, my cars paid off, my student loans paid off, my kids through college, maybe my grandkids through college, whatever it is that my personal goals are. Then I can afford some risk with this concentrated stock. Then I can keep enough equity that maybe I can become really rich, make a really big difference.
You kind of take an opportunity on the blue sky, so to speak.
Yeah, exactly, right? But you don't want to try and reverse that. You don't want to try and say, I've become really wealthy or successful with this company here to this point, and I just think it's the only way to get rich in the future, because then you could lose it all.
Well, and the other thing I see in this, and this kind of dovetails with one of the strategies we'll talk about, is folks want to deleverage gradually. Because of the tax hit, that they look at the number like, what would it take for me to deleverage, or not deleverage, but deconcentrate?
Yeah, exactly.
Unwind all
it
at once.
Yeah,
and they're like, I can't
afford that hit.
Number. Right.
I can't afford that hit. And
so I'll piecemeal it and basically create my annual annuity by just selling. But then they risk, as you're pointing out, the potential that all that accumulated wealth, all that unrealized gain in their portfolio could evaporate just as quickly the next year.
That's exactly right. And so there's lots of ways to handle that. So we're coming up on the end of the year 2020, so it's a great time to do it, because over the next 6 months you have 2 tax years that you can worry about. So you can sell some between now and December 31. And that'll be hitting this tax year's statement, and then you can do some, January 2nd or later, and they'll be hitting next year's tax statements. You've already diversified, but you've gotten rid of quite a bit. So even just at the end of the year doing some planning are good. But there's lots of strategies where you could reduce your risk over time, and I'd love to talk with you about that.
Yeah, so from an investment strategy, what my goal is to get folks more money out of that deconcentration of their position and leave more for you to work with for them. And so just because these meld together so well, if someone is in a position where they have what might be long-term capital gains in that concentrated position, like we're not talking compensatory grants here.
Right, exactly.
So just talking about folks who have long-term capital gain holdings, meaning they own the stock outright now, and it's just ballooned in size.
And there's a number of stocks like that.
And the word I used to, I think, apply to what you were talking about before is core capital. If someone can identify how much core capital they need to generate income to produce or maintain the lifestyle they want for X amount of years, like you say, every plan should have a financial planner involved to help people come up with that number, because you got to adjust for inflation. You got to factor in when your kids are going to college. You got to factor in the new cars you need to buy. I mean, all that stuff factors into that number, right?
And more.
Okay, so the easiest way, and probably the most tax-efficient way to manage those assets and to decentralize or deconcentrate them, I'm going to come up with 5 different words by the time we're done with this podcast, is the charitable remainder trust.
I love the charitable contribution idea. So if I have a $100,000 tax problem this year and I make a $100,000 tax deductible charitable gift this year, I've just wiped out my tax benefit.
But I'm going to do you one better
costs
here, because with the charitable remainder trust, you're going to put the appreciated stock into a charitable trust, and you're going to sell the whole lot, and you're not going to recognize $1 of tax.
You see, that's fantastic, because my stock I bought at $5 and it's worth $100 right now. I just saved myself $95 in appreciated gain that I don't ever have to pay.
And you get to reinvest it. Well, you do have to pay it. So I'm going to, so this is where we need to go through the strategy and how it dovetails with what your typical profile is. But you pay it, but you pay the piper when the piper pays you. So when the money comes out of the charitable remainder trust, that's when the tax comes out as well. But that's a lot easier. Again, that's
that's
same,
over many years,
right? That's the same
Right.
strategy as someone saying, "Well, I'll sell off piecemeal every year, and then I'll only pay the tax as I paid off." But this way, you get to harvest all those gains inside a charitable trust, pay zero tax when you do that diversification. Then you get to work your magic reinvesting that portfolio, which is some of the stuff I want to hear next. But then they're only having to take out their annual slice, which can be managed much more reasonably from a tax management profile.
What a fantastic way that I can make a charitable gift, that I can make something impactful and meaningful in my life and also provide me income that I can rest assured with for the rest of my life. I love it. And avoid all of those capital gains on that appreciated stock.
Yeah, and the reality is, because you're not paying that big tax bill right up front, and you're putting that saved tax hit back to work in the markets, at the end of the day, depending on how much runway you have till your mortality event happens, your remainder, which is the charitable bequest that you talk about, the charity doesn't get anything until that trust unwinds, which is typically on the death of one or both individuals that are beneficiaries. So we're talking 20, 30, potentially for younger folks, 40 years down the road. Almost 100% of that charitable remainder that goes to your designated charity is gains derived from the tax savings. You'll ultimately
fantastic.
get back everything you would have had plus more, because this is so highly tax efficient, and all your charitable bequest is driven off of tax savings.
Hey, when I set up a CRT, do I have to have my charity in mind already? Do I have to know who's going to be the ultimate charity?
No, you have to have a charity in mind, and a lot of people these days are using donor-advised funds anyway, and integrating that with their family wealth giving strategy. But you can also change your charitable beneficiary. So if you say, I want to be DAF number 1, and you change institutions to DAF number 2, or you want to go to church number 1, and you can always change, as long as it's a 501c3, you can always change that charitable. So that's the least
I love it.
problematic issue.
Yeah, that's really important. But I think it's one that sometimes people don't know, that, you know, if I want to make a $100,000 gift, I don't want to give it all to my church or any charity right now, or $1 million gift, whatever it is that I'm thinking about giving. I don't want to give it all at once. And that's not the way a charitable remainder trust works. They're not going to get it for many, many years. And I can change my mind over all those years, but it does eventually, whatever's left over, have to go to a charity of some sort.
Yeah, and the last thing I'll throw in here in terms of how effective this strategy is, because we often use this with another charitable strategy we'll talk about, but you do get an upfront deduction for the amount you're putting in. Right now, because interest rates are so low, and this is a kind of a net present value discounting type of deduction that we're taking, the relative benefit, it's not inconsequential. It's just a little less compelling as a reason to do the strategy.
Right.
You get a tax deduction, and it's great, but that's not the reason anymore. People used to, when the interest rates were higher and the value of that remainder was much higher, it used to be actually a reason to do this strategy, was to get that upfront deduction. Now it's just kind of a nice to have. The real thrust behind this strategy is that tax-free reinvestment of the proceeds from your deconcentration.
Exactly. So now you've got a diversified pool of investments, and we've done math on our website, and I'll make sure to include the link in the podcast at the end, but where you can see that sometimes you can get better rates of return and have less risk in your portfolio than you can by having it all in one. So I love the charitable remainder idea. You did a great job just now describing it. I've got a number of people who could benefit from that, and I'm going to make sure that they listen to this podcast. I want to ask you another question, though. So I've got this idea in my head that there's other ways to give to charities now. Tell me about this thing called, I've heard about, a charitable lead trust.
Charitable lead trust.
Yeah.
And we know them all by their acronyms, so it's,
You and I
it's
do.
actually kind of fun. So
The real world doesn't.
Charitable Remainder Trust, also known as a CRT, or if it's a unitrust, it's a CRUT, which is kind of fun to say. It's a CRUT. With the Charitable Lead Trust, a CLT, or if designed, the typical design on a CLT is an annuity trust. So it's a CLAT. So you have CLATs and CRUTs are our primary tools right now. So a charitable lead trust is interesting. And this is the one that we employ in a lot of those situations with the RSUs or what I'll call the compensatory grants, because there's not a lot, or options. There's not a lot you can do there with, they just don't work with charitable remainder trust, for one thing, because they have to be recognized as income before you can do anything with it.
Right, exactly right.
So unlike with the charitable remainder trust, where we're actually extracting the recognition event out of the person's tax profile, here we're stuck with the recognition event. They are going to recognize the income in this year. So how do we do something
to get a deduction?
To basically buy ourselves a deduction, because we can't even give it away. We have to recognize that income. I can't emphasize it enough, because everybody always says, but what if I just give it? You can't give it away. You just can't. So with the charitable lead trust, what we're doing is we're saying, if you're so charitably inclined that you would be giving something away anyway, people who belong to church, who do tithes, or people who are just generally supporting causes, and they know that given this newfound wealth, they're going to be generous to X amount every year. What we do is we say, well, we're now going to set up a trust and fund it in there's a lot of math that goes into this, but we're going to fund that trust with a contribution such that over the next 10 years, we're going to give away $1 million. And I've just done some recent computations on this, and I'll tell you, given where the 75-20 rate is right now, like I said, that discount rate, 0.4% discount rate. So what that means is we're taking the current value of that 10 years of gifts, and we're taking the deduction for it all now.
In 1 year.
In 1 year.
So that's pretty big.
So that $1 million gift that we're going to give over 10 years is now worth $978,000. But we've only funded the trust and maybe given $100,000 away this year, but got a $978,000 deduction.
Huge tax savings.
So and then in those later years where we're not going to need the tax deduction, assuming we don't have recognition events every
single year.
But in that case, we can just do clats we can layer clats on top of clats.
Sure.
But what we're doing is we're recognizing that I could give these gifts away in future years, but I'm not going to have the same level of income problem, of tax problem. So I'm just going to take that full deduction now. And so a $978,000 deduction, I mean, you do the math, at call it 42, 45%.
Huge tax savings.
That's 400 and something thousand more dollars for you to invest per million.
Right. It's huge.
So I've had clients do these in the $1 to $6 million range. Over a period of 10 to 20 years. But you can, like I say, we could do one series of clats. That's a 5-year clat, a 10-year clat, a 15-year clat, and a 20-year clat. And you might ask, why would I do that? Because at the end of the clat term, 5 years, 10 years, 15, all the money in that trust comes back to you.
Right.
All you've given away is that annuity. So if I put $1 million in and it's a 10% clat, which is this one I gave the example of 10 years, $100,000 a year. Now, you may not hit 10% return per year.
You never know.
But some years you might do great. If you end up with more in that clat at the end of it comes back to you. If you end up with less, it comes back to you. So some of the fund strategies there involve what I call endowed clats, which is where the annuity is less than your anticipated return. So the amount in that clat's actually growing.
Continues to grow.
And I don't know if I should throw this grenade into the conversation right now. Then it becomes also an estate planning tool because, again, the IRS is only assuming that your investment return on that is 0.4%.
Amazing.
And so in this hypothetical of $1 million, 10-year, 10% clat, they only expected $21,600 and something to be in there at the end of 10 years. So I can give that $21,000 future interest, and I'm using air quotes, because we all know it's going to be worth more than $21,000. You're going to do better than 0.4% investment return.
And that'll be in my estate.
I can transfer that into an irrevocable trust using my annual gift tax exemption of $15,000 plus $7,000 of my lifetime exemption to move $1 million out of my estate.
Fantastic estate planning tool.
It's the most remarkable estate compression tool I've seen in my entire period of practice. I mean, we use discounts, as you know. We use all sorts of compression tools to get wealth out of an estate. This 0.4% discount rate over an extended period of time does more to compress value in a potential gift transfer than anything. I mean, can you imagine gifting your children $1 million for an estate tax cost of $7,000?
No.
Yeah. Well, you can now.
That's fantastic. What a great story.
Thank COVID for that.
Yeah. Right? I mean, low interest rates forever.
Right.
Woohoo. Well, that is just a great example of some of the advanced financial planning we do here on the expert team. And we managed to cover some pretty heavy topics here in only 20 minutes. The two big ideas we had today are the charitable remainder trust and the CLAT, or the charitable lead trust, and huge tax savings either way you go. Thank you, Nate, for your expertise. I absolutely love it. I can't wait till we do our next one.
Well, and the next time I want to hear a little bit more about how you approach the investment strategies for these folks that are deleveraging or deconcentrating.
I can't wait for the conversation.
Looking forward to it. Thanks. And that'll be it for our podcast today.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.